Most people believe their bank balance represents ownership. You open an app, see a number, and assume that money belongs to you in the same way your phone or your car belongs to you. That assumption feels obvious. It also happens to be wrong in a very specific, very legal way. And the reason this matters is not philosophical, it's operational. Because when stress hits the financial system, ownership is the difference between access and apology. Here's the uncomfortable truth. The moment money enters a commercial bank, it stops being your property. Not metaphorically, not kind of, legally. What you now hold is not money, but a claim, a promise, an IOU backed by an institution whose survival depends on confidence remaining intact. And confidence, as history keeps reminding us, is not a stable asset. This isn't speculation or cynicism. It's contract law. It's balance sheet mechanics. It is the framework adopted after 2008 to make sure the next crisis doesn't look like the last one. And if you think that means things are safer now, you haven't read the fine print. When you deposit funds, you become what the legal code classifies as an unsecured creditor. That phrase sounds abstract until you translate it into plain English. It means you are lending money without collateral to an institution that is free to leverage it, rehypothecate it, and deploy it as it sees fit. In exchange, you get instant liquidity until you don't. And before anyone says this sounds dramatic, let's ground it in something recent. Just weeks ago, Wells Fargo customers woke up to frozen accounts. No advance notice, no consent, no meaningful explanation. Cards declined, apps locked, customer service reading from scripts. The media called it a glitch. Wells Fargo didn't. They called it temporary limitations on transaction processing. Words matter, especially in legal departments. 14 hours doesn't sound like much unless you need gas, groceries, or rent access, unless that 14 hours turns into 14 days or 14 weeks. The key point isn't the duration, it's the precedent. Access is conditional, always has been. What most people missed is that this wasn't a failure. It was a test, a liquidity drill, a behavioral experiment. How do customers react when access disappears? Now, the answer, apparently, is that they complain, wait, and then forget, which tells institutions exactly what they need to know. Because when a real crisis hits, it won't be labeled a glitch. It will be labeled stability. Now let's talk about what actually happens when a bank fails in the modern system. Not a bailout, a bail-in. Those are not interchangeable terms, and confusing them is expensive. After 2008, policymakers decided that taxpayer-funded rescues were politically radioactive. So instead of eliminating risk, they changed who absorbs it. Enter the Dodd-Frank Act. Specifically, Title II, Orderly Liquidation Authority. This section gives regulators the power to resolve failing systemically important financial institutions without using taxpayer money. Sounds responsible. The mechanism, however, requires losses to be absorbed internally by creditors. And depositors, legally speaking, are creditors. The law allows the FDIC, acting as receiver, to realize upon the assets of a failing institution. That phrase doesn't mean protect, it means use, convert, restructure. And since deposits are legally the bank's assets, they are available for that process. This is the part no one likes to hear. Your money isn't sitting in a vault with your name on it. It's pooled, leveraged, and counted as funding. You don't own the dollars. You own a claim against a balance sheet that may or may not be solvent when you need it most. In liquidation hierarchy, that matters. Secured creditors come first, senior bondholders come next, depositors come later, sometimes last, and when there isn't enough left, claims don't get honored. They get restructured. If that sounds theoretical, it isn't. Cyprus, 2013. Depositors with balances above $100,000 lost nearly half of their funds overnight. Not through taxes, not through fees, through conversion. Their deposits were turned into equity in failing banks, stock certificates in institutions that were already insolvent. No legal recourse, no appeal. It was authorized, planned, executed. And here's the key point. The U.S. adopted the same framework, different language, same mechanics. Title II is the American version of the bail-in model. Now, people often say, but FDIC insurance protects me. That belief is only partially correct and dangerously incomplete. FDIC insurance is not a magical shield. It's a fund. And as of late 2025, that fund held roughly $128 billion to insure over $10 trillion in deposits. That's about 1.2% coverage. If even a small fraction of depositors demand access simultaneously, the math stops working. At that point, insurance becomes a political decision, not a guarantee. And political decisions take time. Markets don't. So when confidence breaks, institutions don't ask whether you're insured. They ask how to stop outflows. And the law gives them tools to do exactly that. This is why the distinction between ownership and claims matters. A digital dollar is a database entry. It exists because a system remains functional. It requires servers, counterparties, clearing mechanisms, and institutional solvency. It's efficient until it isn't. A physical asset doesn't require permission. This is where silver enters the conversation, not as a speculative trade, not as a get-rich-quick scheme, but as a balance sheet reality. Silver has no counterparty risk, none, no issuer, no promise, no dependency on a bank remaining open on Monday morning. When you hold physical silver, you're not holding a liability, you're holding property. An asset that has survived monetary resets, regime changes, defaults, and collapses for thousands of years. Not because it's glamorous, but because it's final. Silver doesn't freeze. It doesn't need a bailout. It doesn't get converted into equity. There's no customer service number you have to call to access it. And no regulator can decide it's temporarily unavailable. That doesn't mean it's perfect. It doesn't pay interest. It doesn't send notifications. But it also doesn't lie to you about what it is. And this isn't about abandoning banks or living in paranoia. It's about understanding structure, about knowing where risk actually sits, about recognizing that convenience is often purchased with vulnerability. The financial system runs on confidence, always has. When confidence holds, everything feels safe. When it breaks, legal definitions suddenly matter a lot more than feelings. So the real question isn't whether a crisis will happen. It's whether you've positioned yourself as an owner or a creditor when it does, because one of those gets options, and the other gets a letter thanking them for their cooperation. There's a moment most people never think about, because it happens quietly and far away from their daily lives. It's the moment a bank fails. Not the headlines, not the press conference, the actual mechanics. And in that moment, something very important becomes painfully clear. Your relationship with the bank was never ownership. It was credit. When a bank goes under, your claim doesn't magically turn into cash. It goes to bankruptcy court. You get a number, you get in line, you stand behind secured lenders, behind bondholders, behind institutions that understood the rules better than you did. And if there's anything left after they're done, you might get a distribution. If there isn't, you get a letter. Very polite, very professional, thanking you for your participation in the orderly liquidation process. That's the digital dollar. That's what almost everyone today believes is money, but it isn't money. It's credit. It's a loan you made to a leveraged institution, backed by confidence, legal frameworks, and a hope that nothing breaks at the wrong time. Now compare that to silver. Silver isn't a promise. It isn't a contract. It isn't dependent on a clearinghouse, a settlement window, or a functioning payments network. It's an element, atomic number 47. It exists whether banks exist or not. Governments can ignore it, misprice it, suppress it, or pretend it's irrelevant, but they can't erase it. You don't need permission to own silver. You don't need approval to transact with it. You don't need a third party to verify that it's real. If someone is willing to exchange goods or labor for it, the transaction is final. And that's been true in every civilization that has ever existed. Silver has been money for roughly 5,000 years. Fiat currencies, by contrast, average about 27 years before they fail, reset, or get replaced. That's not an opinion. That's historical data. And it's not a coincidence. It is the market's long-term audit of what actually holds value when systems come under pressure. Gold and silver endure because they can't be created with a keystroke. They can't be diluted by policy. They don't depend on someone else's balance sheet remaining solvent. Finite assets behave very differently in a world where money is effectively infinite. And when I say silver has zero counterparty risk, I mean exactly that. Owning silver removes you from the entire dependency chain that makes the modern financial system fragile. You're no longer relying on a bank to stay open, an insurance fund to be adequately funded, or a central bank to react quickly enough. You're relying on physics, on chemistry, on the fact that a tangible asset with industrial demand monetary history and physical scarcity doesn't care about press releases. In a world where institutions freeze accounts, redefine access, and quietly normalize restrictions, that independence has value that doesn't show up on a yield statement. Which brings us to interest rates, because this is where a lot of people get misled. Right now, banks are advertising 4%, maybe 5% on savings accounts. It looks attractive, it feels responsible, but what you're actually earning isn't a real return. It's a partial rebate against inflation, not the sanitized CPI number. Real inflation, monetary inflation. Between early 2020 and early 2022, the M2 money supply expanded by roughly 27%. 27% more dollars in just 2 years. That dilution doesn't disappear because your savings account pays 4%. It compounds against you. So what you're really doing is accepting counterparty risk, liquidity risk, and systemic risk in exchange for a return that doesn't even preserve purchasing power. That's not investing. That's volunteering to lose slowly, and the timing couldn't be worse. We're coming off the longest experiment in artificially cheap money in modern history. Rates sat near zero for most of the period from 2008 through 2020. Debt piled up everywhere. Corporations refinanced endlessly. Commercial real estate projects assumed permanent low rates. Banks loaded up on long-duration bonds at yields that only made sense in a zero-rate world. Then rates rose, and the cracks appeared immediately. Silicon Valley Bank didn't fail because it was reckless in the traditional sense. It failed because it borrowed short, lent long, and assumed rates wouldn't move. When they did, the bond portfolio collapsed in value. Withdrawals accelerated, losses became real, capital vanished. Then Signature Bank, then First Republic, then Credit Suisse, a global institution that didn't just stumble, it disintegrated and had to be absorbed to prevent contagion. Each time we were told it was contained, each time new facilities were created, discount windows expanded, emergency lending normalized, liquidity injected. But the underlying problem did, and legally they can do it. The authority already exists. The Bank Secrecy Act, the Patriot Act, emergency powers, executive orders, all of it allows transaction suspension when systemic risk is deemed high enough, and your consent is not required, because the funds aren't legally yours. History doesn't make this hypothetical, it makes it obvious. In 1933, the US government ordered citizens to surrender their gold under penalty of prison and fines. People complied, and shortly afterward, gold was revalued upward by 70%, a massive legal wealth transfer. Now, this isn't about predicting a repeat of that exact scenario. It's about recognizing a pattern. When systems are under stress, control tightens. Capital moves get restricted, rules change quickly, and the people who prepared beforehand don't need permission to survive it. That's why physical assets matter, and that's why silver, specifically, matters for everyday people. Gold is powerful, but it's expensive. It's efficient for large sums. Silver is accessible, it's divisible, it allows gradual accumulation. You don't need a six-figure portfolio to start removing yourself from systemic risk. Every ounce you hold physically is an ounce that cannot be frozen, bailed in, or converted into someone else's solution. And there's another layer most people aren't watching. The physical silver market is incredibly tight. Above-ground investable silver is estimated at around 2 billion ounces. Meanwhile, the paper markets trade claims representing multiples of that amount. On the COMEX alone, open interest often represents hundreds of millions of ounces, while registered inventory available for delivery sits in the tens of millions. That leverage only works as long as most participants never ask for the real thing. If even a small percentage demand delivery, the math collapses. Prices reprice violently. Contracts get settled in cash. And suddenly, the difference between owning silver and owning a promise becomes very real. Central banks understand this dynamic. That's why they've been accumulating hard assets at record pace. They aren't doing it for decoration. They're positioning for a world where trust in fiat systems is less stable than it looks. So the question isn't whether this matters. It's whether you act before access becomes a discussion instead of a right. Because history is very clear on one point. When the exits get crowded, it's already too late to move. And the people who understood that ahead of time don't need to rush. Before we go any deeper, there's something I need to clear up. Because if I don't say it plainly, people will fill in the blanks for me. The mainstream media is not designed to tell you how the banking system actually works under stress. They're not evil cartoon villains, but they are structurally dependent on the same institutions they're supposed to question. Banks advertise. Financial institutions sponsor. And when your paycheck depends on not upsetting those sponsors, certain topics quietly disappear from the script. I don't have that arrangement. There are no bank sponsors here. No financial institution advertisers. No glossy partnered with logos. This channel exists because viewers support it directly. That independence is the only reason I can talk openly about bail-ins, counterparty risk, and laws most people have never read but are absolutely subject to. If that matters to you, if you value research that actually reads legislation instead of press releases, use the super thanks button under the video, $2, $5, whatever you can spare. That support keeps this channel independent because the moment I take money from a bank, this conversation is over. You don't get honest analysis from someone who's contractually paid to stay quiet. All right, with that out of the way, let's get practical. The first thing you need to do is accept a reality most people have never been told clearly. When you deposit money in a bank, you are not the owner of that money anymore. You are an unsecured creditor. Your deposit is a loan to the bank. That's not an opinion, it's contract law. You can dislike it, you can ignore it, but it doesn't stop being true just because it's uncomfortable. Once you accept that, step 2 is simple math. How much of your wealth is inside the banking system right now? Not just checking and savings, but money market accounts, cash-like instruments, anything that relies on a bank remaining functional. How much of that is above the $250,000 FDIC insurance limit? And where is it sitting? At a small regional bank or a systemically important institution? These details matter more than people realize, especially when stress starts showing up in the system. Step 3 is where people get emotional. So listen carefully. Reducing exposure does not mean panic. It does not mean emptying accounts tomorrow and trying to stuff cash into your mattress like it's a bad movie. It means being intentional, strategic, rational. The first priority is debt. If you owe money and you're simultaneously holding large cash balances, you're taking counterparty risk for no benefit. If you have $50,000 in savings and $50,000 on a mortgage or loan, you are lending to a bank while borrowing from another institution at the same time. That's not sophisticated. That's inefficient risk. Pay down the liability. Eliminate it. Then take the cash flow you were saving and redirect it into assets you actually own. This is where physical silver comes in. Not paper silver, not ETFs, not digital representations that depend on custodians and clearing systems. Physical silver, the kind you can hold. There are reputable dealers, SD Bullion, Money Metals Exchange, JM Bullion AppMex, companies that have been around for decades. You order online, they ship to your door, and you take delivery. And this part matters. You store it yourself, not in a dealer's vault, not in a bank safe deposit box, because if the bank fails, you don't get access to that box. People always forget that part. A safe deposit box is still inside the system. If the doors are closed, your property is locked behind them. Storing metal at home means responsibility. It means buying a safe. It means not talking about it. It means basic operational security. And yes, that's inconvenient. But inconvenience is the price of removing counterparty risk. If you broadcast what you own to everyone around you, you defeat the purpose. Ownership works best when it's quiet. Step 4 is where a lot of people sabotage themselves, done to try to time the market. I don't care if silver is $28, $32s, or $25. This isn't a trade. It's insurance. You don't buy fire insurance because you think your house will burn down next Tuesday. You buy it because if it ever does, you don't lose everything. Silver serves the same function. You're not betting on tomorrow's headline. You're protecting against systemic failure. The premium you pay is the opportunity cost of not earning 4% in a savings account. But ask yourself a simple question. What good is 4% if your account is frozen? What good is yield if your deposits are converted into equity? What good is interest if the currency loses 20% of its purchasing power in the next crisis? Step 5 is education, and this is non-negotiable. Don't take my word for any of this. Go read the law yourself. Dodd-Frank Title II is public. The FDIC's Orderly Liquidation Authority documentation is online. Read Section 206. Read Section 210. Look at the powers regulators actually have, not the ones people assume they have. Then look at Cyprus in 2013. Read the actual bail-in terms. See what happened to depositors, not hypothetically, historically. Then ask yourself an honest question. Could this happen here? And if the answer is yes, even theoretically, then you already know what needs to be done. Here's what most people don't want to admit. The crisis isn't some distant event. It's happening right now, just slowly enough that it feels manageable. Regional banks are bleeding deposits. Commercial real estate is cracking. Overnight lending markets are showing stress. The yield curve has been inverted for over a year, and it has predicted every recession since 1960 without exception. The Conference Board S leading economic index declined for 20 consecutive months as of December 2025. That has never happened outside of a recession, not once. We're already in the early stages. The only unknown is speed. And here's the thing about bank runs. They don't unfold politely. They don't give you weeks to plan. They happen fast. Silicon Valley Bank proved that. On March 8th, 2023, they announced a $1.8 billion loss and a capital raise. Within 48 hours, $42 billion was withdrawn. In less than 3 days, the bank went from fine to FDIC receivership. That was one bank. Now imagine 5, or 10, or 20. The system doesn't have the liquidity for that. The FDIC doesn't have the manpower to resolve multiple institutions in one weekend. And the Fed doesn't have the political capital to announce another multi-trillion-dollar bailout after years of insisting inflation is contained. So what happens instead? Bail-ins, account freezes, capital controls, always framed as temporary, always justified as necessary for stability. And by the time most people understand what's happening, the decisions are already made. This is why timing matters. Once panic starts, it's too late. Once ATMs have lines, it's too late. Once dealers run out of inventory and premiums spike $15 over spot, it's too late. You prepare before the fire, not while the house is burning. And if the crisis never fully materializes, fine. You still own an asset with 5,000 years of monetary history. You still have wealth outside the system. That's not a loss. That's prudent risk management. For those who accuse this of being fear-mongering, I'll say this plainly. I didn't write Dodd-Frank Title II. I didn't invent the Cyprus bail-in. I didn't fabricate the $684 billion in unrealized bank losses. That number comes from the FDIC's own reports. I didn't imagine recent account freezes. And I didn't invent the illegal fact that depositors are unsecured creditors. So which part is exaggerated? The idea that these risks could become real, because history says they can. 2008, 1933. Every crisis looks impossible right up until it happens. I'm not telling you to sell everything and disappear into the woods. I'm telling you to take reasonable steps to protect yourself against documented risk. Keep enough in the bank to live, to pay bills, to function. But savings, real savings, should not exist as unsecured claims inside a leveraged system. Silver, gold, real estate, productive land, physical assets you actually own. That's the point. And for those who want more detail, my personal strategy, my exit points, how and when I plan to rotate silver into other assets, that's in the members-only content. I've posted a 45-minute deep dive explaining exactly what I'm watching and why. That's not public because broadcasting your playbook to the entire market isn't smart. But for people who are serious, it's there. One final note. Don't wait. Premiums are already creeping up. Silver Eagles that were $3 over spot are now $5. Dealers are reporting delays. The U.S. Mint has been rationing production for years. If another banking scare hits, physical supply will vanish quickly. Act before the crowd does. Owners move early. Creditors react late. The money in your bank account is not your property. It's a loan. You are a creditor. Bail-ins are legal. They have happened before. They can happen again. The solution isn't panic, it's ownership. Be an owner, not a creditor. Because when systems break, owners have options. Creditors get letters.